Good morning, everyone, and welcome to the Fire Chat on Digital Credit Beyond Consumer Finance. My name is Chiara Pescatori, and I'm a consultant, and I'm going to moderate this Fire Chat today. By definition, with the term digital finance, we intend a broad range of financial services accessed and delivered to digital channels, including payment, credit, saving, remittances, and insurance. But today, we're going to focus on credit. In the last decade, digital finance services have experienced a fast-paced growth that has contributed to the expansion of financial inclusion, and this is particularly true for digital credit because they are rapid, private, and convenient. Borrower can access a small amount with a quick tap on their mobile phone, while financial service providers have become more efficient, expanded the outreach, and reduced the cost. With the progress made, the industry started engaging in a passionate debate about the design of this digital credit. How can we avoid a consumer credit bubble? How do we make sure that short-term household needs and business are promptly met? How do we ensure the market develops in a way that supports low-income users and creates value? Not to talk about how the ecosystem should be externally evaluated and regulated. Today, we will try to answer those questions and contribute to the debate with three engaged and experienced practitioners who will bring their perspective and direct field experience. As you can see on the right, there is a chat box where you can put your question. And if you'd like to direct one question to one of the speakers, please enter their name there. Without further ado, let me give the floor to our speaker for a brief introduction. Please, Michael.
Yeah, hi everyone, and thanks for having me. I'm Michael Roth. I'm one of the founders of Flow, and Flow delivers enterprise digital finance solutions. So we use digital technologies to finance businesses and businesses only.
Thank you. Anup, please.
Great. Thank you so much for having me here. It's a wonderful opportunity to speak on the topic of digital credit and how we can move the needle beyond the consumer credit. My name is Anup Singh. I'm based in Nairobi. I work for Microsoft Consulting, and I'm the regional head for Anglophone Africa.
Thank you, Anup. Please, Ben.
Great. Yeah, good morning and afternoon, everyone. I'm Ben Wallingford, Regional Manager for Anglophone Africa at MFR. MFR is a rating agency which is specialized in responsible, inclusive finance. And we've been operating for over 20 years with a head office in Italy and several regional offices, including in Kenya, where I'm based. And we're working with different types of companies in financial inclusion who are serving the base of the pyramid with our ultimate goal to bring transparency to the industries we operate in and to facilitate responsible investments. And we do this by carrying out financial and social ratings, certifications, and other types of assessments for financial service providers, including digital providers and other types of companies like mobile money operators. I'm looking forward to the discussion.
Good, great. Thank you, Ben. Thank you, guys. So let's get into the weeds of the discussion. So my first question to you would be a general one. What digital credit means to you, and what are the challenges and opportunities you see the industry is facing now? And we would like to hear your perspective. Please, Michael, want to start?
Me? Yeah, sure. Yeah, so when I think of digital credit, the first thing that comes to my mind is that digital credit can achieve what microfinance has been unable to deliver. Okay, I think microfinance has made great advances compared to traditional banks in including informal and small businesses. But let's be honest, there's still hundreds of millions of small businesses which are excluded, and there's still a credit gap of billions of dollars, right, for small, medium finance. So here we have the opportunity to, with digital technologies, eliminate those barriers. And the key barriers are that banks still require collateral from business, and small businesses don't have collateral, and that traditional brick and mortar models have too high operational costs. There are challenges and there are villains, and I think we need to provide a framework to absorb the negative effect the villains can have. But none of this is new from my perspective. So transparency and consumer protection is an issue in traditional banking. It's an issue in microfinance. The way we implement this might be different. and we must implement it. But the principles of consumer protection remain the same. So I think the challenge is exactly the same. We need to distribute financial services in a transparent manner, in a fair manner, but the potential is unprecedented, and we should look at exploiting the potential and providing an environment in which we can harness the power for good, right? Including small and independent businesses.
Thank you. Anup, what would you say about that?
Thank you so much. So maybe I can talk about one of the studies that we did on assessing the digital credit landscape in Kenya in 2018. And we also looked at a few East African markets. So MSc conducted this study with support from SPTF and Smart Campaign and funded by the French Development Agency. What we found out is that most of the borrowers are using digital credit to manage their business as well as consumption expenses. And the customers really appreciate the convenience and immediacy of the product. What we also found out was that a typical digital credit user in Kenya is young urban male. So while this is a good methodology to expand access to credit to number of people, what we are seeing also is that digital credit is now contributing to widening the digital divide. So we can think about people who are middle-aged or old, people who live in rural areas and remote areas, and women who are at the other side of this digital divide, the digital exclusion. What we have also seen is that factors like the quality of smartphones, the data coverage, the mobile data price, and so on and so forth, actually contributes to low income users to their lower access to digital credit. And also the fact that the digital literacy is quite significantly lower for women and rural customers, which further enhances the risk that is around exclusion of these kind of customers who were already underserved. So the core question, and linking it back to what Michael mentioned, that what microcredit could not do, digital credit could do. But is it doing it? That's the question that we are asking. On the supply side, what we are seeing is that most of the suppliers, the service providers, are actually feeling that there is insufficient regulatory oversight, and a lot of advocacy is there when it comes to the policy and regulatory guidelines for the digital credit industry. We are also seeing that quite significant number of users are negatively listed because of the high rate of delinquency. We do understand that digital credit operates on the principle of high risk, high return. Then there's also, because people now see many number of people who are negatively listed because they borrowed $5, $10 using a digital credit platform. Some of people who are now kind of mentally postponing the decision to borrow using digital credit. The last aspect is very, very important. We are seeing that the interest rates are still very, very high. When in 2012, M-Shwari started as digital credit and became the trailblazer in setting up this whole digital credit industry, there was this thought, there was this idea that over time there will be better understanding of the client and their risk profile, and there will be lowering the cost of digital credit because of use of digital technology. This hasn't happened yet. We are not seeing that now digital credit at scale actually has reduced interest rate and it has trickled down to the customers, and customers get benefited. Kiara.
Please, Ben, what's your opinion about that?
Well, in our experience, digital credit for sure is not all good or all bad. Similar to the rest of the financial inclusion industry, there's some providers who are more responsible and others who are less so. And of course, there is a potential for positive impact in digital in terms of convenience to enhance the customer experience, increased outreach and growth into both existing client segments and new ones, and ultimately the promise of a greater financial inclusion. But these opportunities can only be realized when the service is delivered in a responsible manner, and when those challenges are managed well, such as new types of risks, some that are at institutional level, like say fraud risk or agent management risk, or technology risk, and also at the client level, from a client protection perspective, product design and delivery, transparency, responsible pricing, and data privacy and security as well. Of course, digital is quite a buzzword and can refer to many different business models. It either can be about offering digital financial services or say more technological initiatives that are helping to improve existing more traditional products or increase institutional efficiency. And in digital credit, one helpful way that we've seen to segment is between low touch and high touch. And what I mean by that is the extent of human interaction in the business model, with low touch presenting some more challenges, like say from client protection point of view, in this situation of being on very one end of the spectrum with no branches and fully digital application and appraisal and payments, for example. But I would say that it's most productive for us to focus our attention on how these different models can be operated responsibly. And when would say let's work together to improve the many things that can be done better, and then distinguish, to make and encourage those better practices to grow, including through impact investments into the right type of providers.
Yeah, just to come back on both Anoop and Ben, I think both Anoop and Ben raise very important points and also allude to one thing which from my perspective is a problem in the current discussion, which is that digital credit is often lumped together, right? And just like microcredit, there are very different business models and different institutional approaches. So the research that Anoop mentioned, I think, focuses on consumer-focused digital-only lenders. And there are challenges with this approach, which doesn't mean that business-focused lenders, which also use a human touch, like ourselves Flow, which I will explain later, imply the same challenges. What happens though is because the discussion is still somewhat undifferentiated, providers like Flow are being chucked in the same bucket and then have more trouble accessing debt financing, for example, than, for example, a traditional MFI would have. Because on the debt provider side, there is already the understanding that there are good and bad MFIs, right? Whereas most DFIs, I think, still at this point in time think that digital credit, dangerous and probably difficult. So the work that both MicroSafe and MF are doing is extremely important in thinking about how can we look at these providers in a differentiated manner and what can be the tools to do that. And I think low touch and high touch is extremely important.
Yeah, thank you so much, Michael. Yeah, the three of you mentioned, and as you pointed out now, that digital technology is something just that serves to reach the same end. So it's just a means. What I would like to hear from you is what is, in your opinion, the emerging trend, and that could foster digitalization while ensuring client protection and customer protection. That is something you already touched, but we would like to go a bit deeper. And maybe, Ben, you can get started first. Thank you.
Yeah, sure. Yeah, thinking of client protection in a digital context, MFR had the pleasure to support the SMART campaign in developing and pilot testing client protection standards, which are adapted to digital credit. And these standards were publicly released last year and is really a helpful resource in defining best practice for digital credit that we would encourage the industry to use. And yeah, some examples of those best practices are that marketing should not be employing predatory or deceptive sales techniques. For example, language that is implying a sort of use it or lose it kind of opportunity. Key information on terms and conditions needs to be disclosed, just as we would expect in a traditional model, in an accessible in an accessible manner, during the loan application. And this brings up implications like if we're talking about a basic phone with no internet access, then a web page link is not accessible to that client. And also that customer service staff should probably be available to answer questions, not only in a chat box, but over the phone as well. If we're talking about, low-income customers that aren't maybe as comfortable with the digital channel. On a topic like automated credit scoring, the algorithm rationale should be documented. There should be a review and a test of those variables used in the algorithm, and also evidence of tracking its effectiveness in predicting repayment likelihood over time to ensure that it is actually doing a good job of estimating repayment from a kind of prevention of over-indebtedness point of view. And that pricing strategies should be reducing prices over loan cycles for credit-worthy clients that have a demonstrated track record of on-time repayment. One of the ideas with digital is that at the beginning, the algorithms may not have as much data at the fingertips to be fully effective, but over time, getting more data and having more return clients should then have a benefit not only to the provider, but to the customer as well in the form of lower pricing. And then asking clear consent for specific types of data sharing, because in the digital space, sometimes there is even some more sensitive type of data share than in a traditional one, like say geolocation data. And this should be named specifically in a privacy clause and not part of a general clause buried somewhere deep in the terms and conditions, for example. And lastly, another one I would point out is just at a general point that given the increased third-party partnerships that are often required to deliver digital credit, there's really a need to ensure that all components of the service are well designed and not harming the customer, even if those aren't in the direct control of the provider. And I'm talking about, say, services provided by agents or mobile money providers that can be an important part of the customer experience. So these are just some examples of these best practices that we can move towards.
Thank you, Ben. Anup, what would you like to answer to Ben?
Yeah, I think I agree to most of the points that Ben mentioned. The one issue which we have been hearing from the providers as well is the transparency around the algorithm, because they feel that this is the secret recipe, the secret sauce, which they don't want to share with anybody. And we do understand that most of these algorithms are pretty black box, although we keep hearing numbers like 10,000 data points are being used and so on. In our studies, what we have found out is that yes, indeed, the digital credit, especially the consumer credit side, there are quite a number of issues around consumer protection practices. There is also confusion or dissatisfaction in the user experience because of this low touch approach. And I do agree with Michael that there is a need for building in the human touch aspect here. Around the predatory aspect, we have seen that there's quite significant focus on marketing, especially on app-based lenders. They keep sending notifications and showing it like this is the golden opportunity. If you don't borrow right now, you will lose this opportunity. So use it or lose it. I really like that point, Ben. The other thing is that, one of the barriers that we have identified is the whole distrust of credit providers is coming from the low pricing transparency, and also the terms and conditions. We have to really think about innovative ways on how we can pass on the messages on the terms and conditions to the customers, because right now most of the terms and conditions, the language is pretty lengthy, pretty legalese, and it's difficult for people to understand. And most of the borrowers, because they are in a need or urgency for credit, they just take whatever you say, whatever points are written, they don't read it. And in some cases, the terms and conditions are accessed via a link, which is a hassle to the overall experience. We are also seeing that multiple borrowing is pretty common. In our study, we found that over 62% borrowers had more than one digital loan. And there is a very regular shift between the providers. And in some cases, we have seen that, like about 26.4% of the borrowers whom we surveyed had taken 2 consecutive loans within 30 days. Some of the aspects which really worry, which is worrisome for the digital credit industry per se, is now most of the customers understand what drives loan limit, and hence they have started to game the system because of their understanding of, if we do this, then if we use a better handset and put our SIM in the better handset, my loan limit increases by $10. The other aspect that we need to also focus upon is the whole aspect around low-income consumers now becoming highly prone to betting, and because of ease of borrowing digitally, it is increasing the overall trend. We have also seen that on the side of the betting industry, there are some developments that have happened. So now you can place a bet for as low as 10 cents in dollar terms. And the customers, the low-income customers, they feel that if they take big risks, they would be able to generate big wins, and they see it as a social and leisure activity. And there's also some peer pressure that is inbuilt in the whole betting industry. Lastly, one point that I would want to highlight is that there has been quite a number of cases around identity theft, because the verification by the app-based lender is not that strict. People pose as somebody, borrow on their behalf, and ultimately that person only gets to know when that person is negatively listed in a credit reference bureau. So there needs to be a focus upon the customer protection practices by the digital credit providers.
Thank you, Anup. Michael, on a practitioner perspective.
Yeah, so I'd like to bring the discussion back to the potential, because I think what we've been hearing a lot is talking about a few million retail customers, frankly, who are not behaving well and who are not being treated well. And we're forgetting about the hundreds of millions of businesses who can be included, and for example, in China, are already included, right? So if you look at what Ant Financial is doing, they are an SME lender. They provide credit digitally based on e-commerce data. Now, we are doing something very similar in Uganda. We are providing credit based on business data. We don't look at any private data, any personal data. And that's for two reasons. One, we've seen in our own tests and in independent research studies that financial data, so business-related data, has way more predictive power than any personal data can ever have. And secondly, from an ethical perspective, we don't want to look into when people call their mother or something like that. So I completely agree, this is bad. But if you're not doing consumer credit, I would also hold you don't need it, right? So what we do is we use data to, I think, tailor credit products better to small businesses' needs than any traditional banking or microfinance model could ever do. Because what we do is we look at daily sales, right? So at the moment, our key customer segment is mobile money agents. Why is that? Because there's excellent visibility, data visibility on mobile money. So you have shopkeepers who do mobile money transactions, and they also sell Coca-Cola and mobile phones or other hard items. So through mobile money, we get 100% visibility of the mobile money business, and we can then finance this business activity, right? Only looking at business transactions. We do that in an anonymized manner, so we would even be GDPR compliant if we were regulated in the EU. What we can also do, because of data, is see that they're actually using this money to grow the business, and we've seen after 4 months, on average, these businesses have increased their income by 40%, and some after 6 months have tripled their income. So for example, this has also enabled us to finance businesses throughout the Corona period. So we have actually made money this year throughout the Corona period, and our customers have been able to continue doing business. Now, I don't have the exact data, but I know that many traditional MFIs and banks in Uganda where we operated stopped lending, right? Because they just don't have the real-time and detailed visibility to continue in a situation like that. And I think that's a great testimony to the resilience of the business model and the opportunity of digital credit.
Thank you, Michael. Thank you all. Since also, as you partially mentioned, the topic of this panel today is looking at the way forward. What I would like, and you partially already mentioned it, what I would like to hear from you now is what the industry can do, what is missing, and where the industry can further expand in order to make sure that there is financial inclusion properly done and the digital credit ecosystem is brought further. And yeah, maybe Michael, you can start.
Yeah, I think both Anup and Ben alluded to it already. I think as an industry, we need to not lump digital credit together, but we need to understand the nuances. And one of the things which Ben mentions, which we also do, is we actually combine a human operation with digital. So we use technology for what technology is good at, like automated credit decisions, but we use people for what people are good at, like relationships and qualitative assessments of potential borrowers. And so I think we need to take a step back and acknowledge the fact that any new credit product has a digital element, right? So I think we should look at lending, not just digital credit. And then if you look at how the microfinance sector grew, the microfinance sector really grew when DFIs and commercial money came in to provide refinancing, right? That refinancing is not available yet for innovative digital credit providers, at least not to the extent that they can convert their potential. So I think another big task for the sector is for debt providers to be able to understand digital credit portfolios or new age lenders' portfolios and business models, and then finance them based on the opportunity rather than based on looking back, right? Because if you look at someone like us, we've been in operation for 2 years. We have a loan book of $250,000, but we could grow this to 5 million and thereby really deliver a lot of social impact if somebody looked at us with a venture lens rather than with a traditional banking lens, right? Which looks at balance sheets and audited financial statements from the past.
Thank you. Ben, what would you complement with?
Yeah. Well, I'd say that the digital credit will continue to leverage from ongoing trends that are moving towards increased automation, continued increase in the use of digital delivery channels, also accelerated by the pandemic, of course, to push more towards expanding financial inclusion. And I'd say for digital credit to better serve the market for income generating purposes, productive lending, and especially for large loan sizes, I would say that a higher touch or some kind of a hybrid model between low and high touch, may be the most ideal design, like what Michael has talked about. For example, a digital application, but then a staff or an agent visits the client to verify the business, or maybe in some cases of lower risk to have a phone interview to identify some inconsistencies or risks. So this idea of combining tech with touch. And also for larger loan sizes, I would also say that in the credit scoring, that algorithm should be including disposable income expenses from the business, and other loans as well, to get at the cross indebtedness factor. Not only non-traditional factors, from this prevention of over indebtedness point of view, or at least some financial information being used as a factor. And meaning mobile money transaction records, for example. We may not gather from that exactly what is the business income, but it's cash coming in and cash coming out. Then I'd also say that a verification of loan use, would help to really understand what loans are being used for, in the context of having more productive loan offerings among digital providers. say a tick box for the customer to say, yes, I'm using this for business. If only self-reported, it may not be that reliable. And there's also the challenge in even productive lending that the funds may not be fully utilized for the business, since money is fungible. So some kinds of verifications independently of that can really help to understand what the loans are being used for. As also some of these very low touch digital offerings do end up being used for business in some cases. I'd say that more providers who are operating according to best practices, including from a client protection perspective, would really help to achieve a more transparent and responsible industry, and then that all helps with driving more investment and really furthering the outreach. And one way to achieve that could be an assessment system that, say, uses these digital credit client protection guidelines that I spoke about earlier in order to distinguish between good and not so good practices and incentivize improvements with public recognition for those providers, which could also be endorsed by investors in order to strengthen its adoption. And MFR, we're working on launching a certification methodology informed by these standards for which digital credit providers would be eligible, and it would be tier-based in order to encourage improvements, which I think would be of big help to the sector.
Thank you, Ben. Anoop, please.
Thank you so much. I think we all agree to that there is a clear opportunity to enhance access to credit for micro and small enterprises, as well as the other segments like the mobile money and bank agents. But this would require significant improvement on the design and delivery. And it would also require that we utilize an ecosystem-wide approach so that the end users, they choose, use, and prefer digital credit. And that can be done via 4 focus areas. The first focus area would be to work with the financial service providers, with the digital credit providers, to help them implement and deliver digital credit responsibly. So what does it mean? It means that we have to start thinking about how to focus on creating metrics around affordable pricing, which would be based on repayment capacity analysis. How do we get them to think about appropriate marketing techniques? How can they responsibly communicate with the end users? Also, how can they embed aspects of customer protection and trust? And overall, how can they proactively focus on the credit risk management, because the cost of loan go up because of the higher delinquency. On the other side, we also need to provide the financial service providers, the digital credit providers, with behavioral insights that would be used to develop solutions and nudges for the target segment, especially the micro and small enterprises. And when we talk about these, we need to start thinking about what kind of customers are we dealing with, what is the market, how does the market look like, and how can we embed the whole aspect about the tech and touch. We have been talking about the tech and touch, and I really like what Ben just mentioned, that we need to think about a hybrid model. So there are microfinance institutions with brick and mortar branches and people on the ground. Can digital credit providers come up with a collaboration where these people on the ground can actually run the assessments for them? The third aspect is to start thinking about the technology. So how can we use technology to catalyze the delivery of digital credit? So this is where we need to start thinking about enabling digital footprint. One of the issues that we have is that most of the micro and small enterprises do not have adequate digital footprint. They are thin file customers. So how do we enable those, and how do we aggregate those digital footprint? Also think about what would be the right user interfaces. How can we build robust algorithms? Perhaps there is also a need to start using psychometrics into the digital credit lending or digital lending for the micro and small enterprises. And overall, how do we ensure that the use of digital identity is for the right purpose? It is not being used to defraud the customer. Lastly, as we are working with financial institutions and tech service providers on the aspects of responsible delivery, behavioral insights, and enabling technology, we'll need to start thinking about working with the regulators on conducive regulations as well. So this will mean putting in place the client protection principles, getting approvals on in a regulatory sandbox for some of these digital credit providers to actually test their model on the aspect of data privacy and security, and also the digital identity. So I believe that such a coordinated approach will result in better products, better delivery systems, improvement in portfolio management and collections, as well as better client protection because of the aspect of responsibility, and hence it will sustainably impact the micro and small enterprises and other segments that we are talking about. At MSC, we are working on establishing a digital credit lab where we would conduct action research, work with the financial institutions as well as on the regulators on the side to transform digital credit to be able to reach out to micro and small enterprises and cash in, cash out agents in Asia and Africa, and perhaps beyond as well. Thank you.
Good. Yeah, so I've got news, good news for the sector. Basically, every single thing that Anoop said, we're already doing. So rather than trying to change the villains, you might want to work with the good institutions, right? And I'm sure we're not the only ones, but it's really a good template to look at what needs to be done. I think there was a question on COVID response. So maybe I just describe quickly how we reacted to that and how digital helped us. So when the first lockdown came in Uganda in the end of March, early April, our borrowers, who are, if you remember, they're all shopkeepers, all mobile money agents, they were affected in three ways. Either they were not allowed to even operate their shop because that part of the city was shut down, or they were not able to get there because there were public transport restrictions and they couldn't walk to the shop, or nothing changed, they could keep operating. So what we did is, it was a very difficult question. We decided to keep financing our customers throughout the crisis and restructure loans for those who could not keep operating. What happened is that those who could keep operating actually increased their transactions, because if you remember, most East African governments pushed for mobile money, which was reflected at this shopkeeper level. Now the others were quite good at repaying later, so it was very scary. We had a portfolio at risk of almost 50%, and we're now brought it down to 8% write-offs. So we actually made money in this time because we grew with some customers. And I think most importantly, we were able to foster very strong brand loyalty. These customers are very grateful that when everybody else stopped, we continued. And we were able to do that because we can pull back exposure very quickly, and we can look at data, right? We can look at real activity. And seriously, this was at a time when international microfinance organizations, which have backing of grant money, we have never got a penny of grant money, stopped lending, right? So this is the potential of digital credit. Yeah.
Thank you, Michael. Ben and Anoop, from an assessor on a market evaluator perspective, have you ever seen the impact of COVID-19 on digital credit? And maybe Anoop, you can start first in a couple of minutes, because we have like 5 minutes left.
Sure. Thank you so much. So we did assessments on the impact of COVID on low and moderate income population, on MSMEs, on farmers, on cash in, cash out agents, and so on and so forth, in several countries. Some of it was also funded by some of our generous funders. And what we found out, and I'm just kind of giving you a very high level snapshot of what was the impact on the digital credit industry. So what we found out was that most of the digital credit service providers either reduced their loan limits significantly or became very, very exclusive in selecting who they would be actually providing the loans with. Because there was a significant rise in delinquency that happened, especially in the period between March all the way up to July. Now we are seeing some easing of the digital credit service providers who have now started to enhance their loan limit, but it is not the same as it used to be before COVID era. Before COVID era, it was like free for all. Anybody could enroll to an app and get a loan of say $20, $30 almost immediately. Now they have become much more selective, and some of the app-based lenders who are not actually based in the country have stopped their operations altogether.
Yeah.
Thank you.
So go. Yeah, I would just
No,
they stop because they look at the wrong data, right? If you look at business-related data like we do, you would see that a lot of these informal businesses kept operating. And the other thing I think which they might not be doing is actual customer research. So we have done in Uganda alone interviews with 1,200 agents to understand their working capital needs and complement what we see in the data with qualitative assessments, right? Because there are also elements, we think data is very good for many things, but there are also qualitative elements for which local knowledge and on-the-ground understanding is important. So what we have built is we have built a assessment methodology where we use data for a large chunk, but where human qualitative assessment can also come in to support credit decisions, and the same for the product development aspect of things.
Ben, what is your perspective on that?
Yeah. Well, yeah, we at MFR partnered with CGAP on carrying out a pulse survey on what have been the impacts of COVID on different types of financial service providers. It was a global survey, and showing, of course, deteriorating portfolio quality and a number of other impacts, due to reduced business activity, lower ability for clients to repay, and also a lower demand for new loans. Not only of providers being more conservative with lending, but just because the business is down for the clients and they don't see the usefulness in taking a loan at that time. I think we saw the impact on all providers, really, including digital, maybe a little more on traditional than digital. Thinking about, for example, group meetings, which are not able to take place at all during a lockdown, whereas digital already has that kind of digital repayment mechanism built into the model. I think that in these continued times, that clients may continue to start to prefer digital methods more and more, and for different elements of the customer experience, and the opportunity is certainly there with clients maybe having more motivation and even preferring digital channels. But that's an opportunity and still needs to be delivered in a responsible way and not rushed out, before being well designed to clients' needs and preferences, aspects like literacy and just technology familiarity. And to be well integrated into a digital strategy before those, this increased digitization happens, which many providers are doing fine.
Great, thank you. We have a question from the audience, and since the three of you have great experience in Africa, I would like to address, and this is a question from Kenya. So AM in Kenya, with a long history and massive operation via M-Pesa, 44% of their GDP, should provide fantastic data. Then how Safaricom is not providing a perfect service? Maybe Anup, you can answer that one.
Sure. I would say it's not that Safaricom is not providing a perfect service. If we look at the use case evolution that has happened over the period, ever since 2007, they have come up with, last counted, about 23 different solutions. Two of the use cases are around credit. So one is the M-Shwari, which actually led to the emergence of digital credit industry. The second one is Puliza, which is like an overdraft, over-the-counter kind of product, which is available at the point of payment, which is completely frictionless and seamless. If we look at the commercial goals of Safaricom, it is meeting those goals, and they have their own goals, and hence they are creating products and services that is useful for them. In fact, we were having a conversation with NCBA Bank, the bank that is behind M-Shwari as the bank. They have so far lent out about 32 million loans using M-Shwari platform. That's a huge number. So they are providing perfect service. It's just that this is not a public good, and obviously because it is a solution that has been created by a private company.
Thank you, Anup. There is a question on the credit bureau. Yeah, Michael, you want to answer that? The question is, what would you say about operating in countries that don't have a central credit bureau?
Mm-hmm. Yeah, so I think the question there is also the coverage of the credit bureau, right? So in Uganda, for example, the credit bureau only covers the central bank regulated sector. So it doesn't cover the tier 4 microfinance institutions, and it doesn't cover our customers, for example. So out of our customers, 92% have never taken a bank loan. So that means they don't have what is in a financial card in Uganda. So there's no data on them in the Central Credit Reference Bureau. So what we are doing actually is we are creating credit histories on these borrowers, and very rich credit histories. So some of our borrowers have done 100, 200 loans with us. So we have exact data on, did they always repay on time? So on the same day, what time of day did they repay, and so on. So this is something which, going forward, we think could all merge together, right? Alternative lenders or alternative credit data could be merged together into the traditional credit reference bureau, but that's needs to be done from a government perspective.
Thank you, Michael. There is another question we'll try to, maybe for you, Ben. Chris is asking, I hear about lots of good and responsible data collection that can help the use case of agents because their transaction performance are the most readily available via MNOs. What about the wide range of other MSME business type and where the data isn't easily sitting on the surface for algorithm use?
Yeah. Well, I mean, I think that also in digital, just like what we see in traditional finance, that there is less of a footprint available there for smaller enterprises than compared to MSMEs and especially SMEs. Now, I think that also these algorithms can benefit a lot from using some other kinds of alternative data on businesses. Even for example, using some data in relation to, in a certain country and market, what are the typical returns for a certain type of business, as ways to make that algorithm more effective, as of course any kind of self-reported data is going to not have as much reliability. Yeah, not sure if I answer your exact question. But, yeah.
Please, Anoop. And then
so
short, guys.
We have been working on this kind of a problem that MSMEs, or rather micro and small enterprises, do not have that kind of data. I think there needs to be a two-step process. The first step process would be an MSME development, followed by MSME enterprise finance. So if I talk about MSME development, there are some companies that offer for $2, $3 a month a service, a very basic service that helps you use your feature phone, or in some cases smartphones, to digitize 4 data points. What are the receipts? What are the expenses? Who is owing what to me? And what do I owe to others? And using these 4, and if we are able to work with large number of MFIs, MSEs, and we are able to put together and have that digital data built for 6 months with an incentive that after 6 months this data can be utilized for financing, that would be the first step on moving the alternative data to digital footprint that can then be utilized to build the algorithm. It takes time. We have to first think about MSME development before MSME finance.
Yeah, I think also exactly we need to think about what other data sources are there, right? One is mobile money, excellent data on shops, but there are other data sources, for example, fast-moving consumer goods. So one of our partners is an aggregator which distributes on behalf of Unilever. Now, Unilever has 200,000 shops, at least, in Uganda, which sell their produce, right? Another thing which is happening in all sub-Saharan African markets is ride-hailing. So now you have a digital platform which registers every trip of the motorcycle taxi. Now, this is perfect for financing this motorcycle taxi. E-commerce is the same. Little restaurants are all, or not all, but many, especially since COVID, are now distributing their meals over digital platforms, so we can get an understanding of how many meals do they sell. So we as Flow, what we do is we try not to change the behavior of the customers, but rather try and look where we can find structured data.
Perfect. Thank you. We are running out of time. Unfortunately, I think we can go on discussing this topic for hours. And thank you so much. I would like to thank you, the three of you today, for giving us so precise and thoughtful insights from the industry and from the practice you're doing every day in the field. So thank you so much for being with us today. Thanks to the technical team for helping us. And it's been a pleasure for me talking with you today. I hope the audience enjoyed as well. Thank you.
Thank you very much, Chiara. Thanks, everyone.
Thanks, everyone.
Thank you.
Thank you all for having stayed with us so far. It's time for a little break. Maybe you want to stretch out your legs, go for a walk. We'll be back in 15 minutes.